Ladies and gentlemen, today is a big video. In today's video, I'm going to be discussing the bullish catalysts for a 2024 bull market, and they go deeper than just the halving and the 4-year cycle. We're talking about the halving, the 4-year cycle, presidential cycle theories, also things like the 18.6-year real estate economic cycle, which encompasses the entirety of the 4-year cycle. There are major bullish catalysts in 2024 that suggest a major bull market over the next 2 years. And there's also counteracting evidence, and I'm going to be discussing the bear case, the case that we'll see a recession, the case that Bitcoin will get dragged down by the S&P and stock market. I'm going to be debunking the bearish claims and proposing the bullish claims in a definitive and decisive video. It's long, it's very much worth watching. Ladies and gentlemen, let's get into it. Ladies and gentlemen, in this video, we will not only be looking into the 4-year cycle, we'll be looking into the presidential cycle and the 18.6-year real estate cycle, which both support the 4-year cycle. We'll then be diving into the all-time highs on gold, S&P 500, and the NASDAQ, looking into the potential bearish claims. People are still claiming that the S&P 500 and all the traditional markets will drag down Bitcoin to new lows, or at least hinder its growth. And that will be the catalyst for the end of the 4-year cycle. I'm going to be looking into those claims, looking into why I don't believe them, and why I don't think they have much value at all. Okay, so without further ado, let's check out the VIP group, and then we'll get straight into the video. VIP group on Telegram, you can check out all the information on this group. This group is listed in the description below. This group has the information, the payment information, the PDF of all the historical trading results. We've got a 78.52% win rate. Not only do you get access to the group in which we post those trading signals with the 78% win rate, but also you get access to the group chat where you can speak to about 120 people, VIPs of Wolves Crypto, 24/7 about the market, post charts, whatever you want, and discuss it there. So without further ado, let's get into it. In the first part of this video, I'm going to be looking into the 4-year cycle theory and why 2024 has many bullish catalysts to make this kind of mega bull cycle. I'm not talking about a super cycle. I'm talking about a bull market with lots of catalysts, right? Probably more than we've had before. And I'm going to look in this, incrementally, but ultimately this video is split in two parts. The first part is looking into this bull market, looking into 2024, the catalyst that's around it, looking into where the bull market will go. And then also the second part will be kind of debunking some of the bearish claims and assessing the bearish argument. The argument being the traditional markets will drag down Bitcoin. We're assessing that. We're going to debunk it to an extent. I'm going to show you why it's not logical to trust it. So without further ado, let's get into it. I've said that 3 times now. Let's actually get into it this time. Okay, so 4-year cycle theory. I'll be quick with this video here. 4-year cycle theory, what is it? Most people know what it is. Every 4 years, Bitcoin does the same thing. As a 4-year cycle, within that 4-year period, there's a bull market, there's a bear market, there's an accumulation period, right? Right now, we're in the accumulation period before the halving. The halving is in April this year. Okay, it's around 75 days away from the time I'm making this video. And so at the halving, we will see the start of a new cycle. And at the start of a new cycle, we see a bull market. We saw a bull market in 2013, 2017, 2021, and then also going through to 2025, we will see a bull market again. 2024, 2025, that will be our bull market period. Obviously, we're in 2024 now. And look, I want to make something very clear. From a cyclical perspective, going upwards is not the same thing as seeing a bull market. A bull market is a period of time after the halving where regular crypto money cycle flow occurs. Now, what do I mean by that? I mean money cycle flow in the fact that we see BTC. So we have BTC at the top. We have Ethereum in second. We have altcoins there. And then above BTC, really, I mean, below altcoins, we have USDT or stable coins or cash, whatever it may be, right? So this is the crypto money cycle flow. It's kind of the food chain in crypto that happens at the start of every bull market after the halving. Now, before the halving and in the bear market period, everyone flocks to BTC. They go from stable coins into BTC. Then when BTC pumps off, reaches new all-time highs, people get more of a risk tolerance. They start going into Ethereum for high gains. Then you see altcoin season, people go into altcoins, and then the market crashes. We see the bear market, people go from altcoins into stables, and then from stables in the bear market, they invest in BTC. It comes back around because they're looking for something to be in the crypto market by, which is BTC, with also lower risk tolerance because they've just been stung by altcoins in the previous cycle. Okay, so that's the money cycle flow chart on cryptocurrency. That starts after the halving, and it's only in regular bull markets like what we saw in 2021, what we saw in 2017, 2013, and what we're going to see this year and next year, that you see this money cycle start to flow. That's the difference between going upwards and seeing a bull market. A bull market is more aggressive, it's more volatile, but it also has much higher gains, right? And that should be occurring after the halving. Now, that bull market, as per this chart here, we can do various date range analysis trends. We can look at, again, we have 5 separate date range trends right here, color-coded. If you look at this yellow one, for example, 500 days from bottom to halving, and you go to the appropriate color-coded date range measurement on the chart, you can see that that measurement takes us to the halving, right? From the bottom to the halving, 517 days. The halving will be in April 2024. All right, and that's correct as per the predictions of the halving. You can also look at another one, days from top to top, 1,400, right? Going from 2013. From 2013, it's all 1,400 days roughly from the top to 2017. Same thing occurred in 2017, 1,400 days to top in 2021. You know, all of these trends have uses, but it comes to the point where all these trends work together to predict something very specific. And what it predicts is that we should be seeing the all-time high on Bitcoin in October 2025. It doesn't give us a price target for it, but it gives us the date. October 2025 will be the end of the bull market if we see a traditional cycle, right? Now, there's price targets we can come to. I've got price targets, but that's not what this video is about. The point is, we should be seeing a regular bull market after the halving. You know, based on all the information we have now, there's no reason why that won't occur, and that will take us to a top in October 2025. Now, what do we have to support that besides the 4-year cycle, right? Because the 4-year cycle is very strong. It's the strongest trend Bitcoin has. As I said, it's based on 5 separate date range trends. It's also based on a fundamental event being the halving. The halving rewards, the mining rewards half, right? So it's very strong alone, but there actually are things that support it outside of the trend itself. One of those things is the presidential cycle theory, okay? Now, there's a theory that goes around, it's not really a theory, it's actually a trend itself, that in presidential election years, which is 2024, which is 2020, which is 2016, right? So this so happens to halve up, you know, this so happens to line up with the halving date. We see returns in the stock market and traditional markets be very high, higher than usual, right? So what we see actually is in election years, the average stock market return, S&P 500 return in this document here, as you can see, is 11% on average. Okay, when Republicans are elected, it's 15%. When a Democrat's elected, it's 7%. Now, Donald Trump, at the moment, I believe, is polling to win the presidential election, so we could be seeing more something like a 15% return. Obviously, it's very doubtful. There's many things that could occur that would kind of screw that up, so let's just go with the baseline 11%. The fact of the matter is, the stock, the S&P 500, its average return in general over all years is only 8% or 7%. So the election year return is 3 to 4% higher than the average return in the S&P 500. And it is the election year now. Okay, it's 2024, we're seeing the election year. So not only is the 4-year cycle strong by itself, but it's also supported by the presidential cycle. Okay, so presidential cycles, presidential elections happen at the same time as the halving, which supports the Bitcoin bull market because we know that Bitcoin and the S&P 500 and traditional markets in general are correlated to a certain extent. So if the S&P 500 is seeing a bullish time, it's very likely, not always, but it's very likely that Bitcoin will be seeing a bullish time. And so the presidential cycle theory very much supports the 4-year cycle trend. So it goes deeper than just the 4-year cycle. It's not just, oh yeah, we're making date range measurements and if they keep going on, we'll do this. No, it's like this is supported by the strongest level of date range measurements I've ever seen. On top of that, the halving event on Bitcoin. On top of that, the presidential cycle theory, which is outside of Bitcoin, right? So something that's more traditional market-based supports the 4-year cycle on Bitcoin. On top of all of this, we've got the 18.6-year real estate and economic cycle, right? So this is something from Jason Pizzino. I'm not sure he's the one who created it or whatever. I think there's many people who have spoken about it many times in the past. Obviously, we've got him listing them right here. You can go to this Twitter post if you want. All these people are responsible for this identification of the 18.6-year cycle. You might not have heard of it before. It's not very important to get into the nitty-gritty of it. You can do that in your own time. But basically, there is a economic cycle that lasts around 18.6 years. Let's just say 18 years. You can see it on this chart here. Now, it specifically works for housing prices. And so we're covering all bases here. And you can see that basically we have this chart basically showing you the exact years in which different parts of this cycle have occurred. And if we're going to the current cycle we're in now, you can see 2011 to 2012, we started the upwards trend. 2020 put a dent in the armor, but we went upwards from there. And then it's expecting a kind of a blow off top in 2025 to 2026, and then a crash downwards towards the end of the decade here. And then going into 2030, 2029, we start tapering up again, right? So the point is basically that we will be seeing a major bull market across housing prices but across the entire economy, really, from 2025 to 2026, or going into 2025 to 2026, and 2024, of course, is included in that. As you can see, he circles "we are here." So this is pretty big as well. So now we've got a situation in which not only do we have the 4-year cycle, which is predicting a 2025 bull market top, we also have the presidential cycle, right, which is predicting 2024 to be great, and the kickoff of the bull market, which is the same thing the halving is predicting. And then we also have an 18-year, I guess you could say, economics trend. They call it the 18.6-year real estate cycle, that predicts the same things that these both charts predicted, that supports the idea of a 2025 to 2026 top, which is exactly what the halving and the 4-year cycle suggests. So I want to just kind of show you, and the reason why I'm making this video really, and the first part of this video specifically, is to show you that it's not just random date range measurements alone that predict that Bitcoin will be entering a bull market after halving, okay? It's actually very diversified into real estate, into traditional markets, and also into Bitcoin. So it's very diversified. It's very supported by things outside of Bitcoin. But even within Bitcoin, even if it was only Bitcoin that led to this bull market, these trends would still be enough. So the 4-year cycle is supported by many things that are outside of the 4-year cycle, and even in itself, it's enough to kind of agree with and go along with. So 4-year cycle is very strong, right? And that's the first part of the video. Now, the second part of the video, I want to kind of point out those things that support it, but the second part of the video are looking into traditional markets, looking into, will the 4-year cycle be ruined? Is there something that could drag the 4-year cycle down? And a very popular claim over the course of 2022, 2023, and now this year, it's still persisting, is the stock market will drag down Bitcoin and ruin the 4-year cycle. That's the claim a lot of people are making. Now, I'm going to debunk this claim now. But before we do that, let's get into a brief 1-minute break.
Ladies and gentlemen, here's a little news flash for you. You trust exchanges with your money. They get hacked all the time. They lose funds all the time. So the exchange you're using, you're actually trusting with your money. You're also paying them fees for trades. You're paying up to thousands, tens of thousands of dollars per year in fees. So you want to have a bloody good exchange, right? And that's why I have 2 exchanges for you guys, 2 options depending on your location, depending on what you want from exchange. The first one is Bitget. That is a KYC exchange. You can sign up from anywhere in the world, excluding the United States, excluding Canada, and excluding Singapore. Very low fees, protection fund, the whole 9 yards. We've also got Bingx. That's our second exchange, and that is an exchange you can sign up non-KYC from anywhere in the world, including every country, right? With a VPN from anywhere in the world. Again, very low fees, protection fund, everything you need in an exchange. Both of these exchanges are top 10 exchanges in trading volume. Sign up using my referral link below to get a 15% trading fee discount on both of the exchanges. Again, they'll both be in the description. Referral link is there. Get on a good exchange and become a proper trader. Don't use these trashy exchanges that you're risking your money and paying over in fees. Guys, let's get back into the video.
So what is the bear case? What are the bears claiming about traditional markets right now, and how are they claiming it's going to affect Bitcoin? They are claiming that the decreasing of interest rates, which will be happening shortly, by the way. We've got an interest rates decision on the 31st of January, but we've got another one here on the 20th of March. And from the 20th of March onwards, it becomes likely, or at least a 46% probability that they start decreasing rates. And then from May, it's pretty much very, very likely, right? We've got 80 or 90% probability here in May. So the point is, in 2024, most likely for the next few months, the Federal Reserve will start decreasing interest rates. Now, if we're looking at a chart here, right, this is the S&P 500 in the candles right here. And we've got in orange the interest rates line right here. So this is what interest rates have been in orange, and then S&P 500 here in candles, right? Now, they are claiming that upon the decrease of interest rates, we will start to see the actual correction of this S&P 500, of the traditional markets in general. Now, they're pointing to 2000 onwards, right? They're pointing to in 2000, when we saw the top, we saw interest rates top, and when we saw the drop, we saw interest rates decreasing massively. They're kind of speculating that it's actually interest rates decreasing that caused that correction. The same is true about 2008, okay? And the same is true kind of, I suppose, I wouldn't say it is actually, about COVID. And the reason I wouldn't say it is because in COVID, this is a black swan event. They dropped interest rates after they saw what was going on, not before. So I would actually say that COVID doesn't count. But basically, they're pointing to these last 2 major bear markets, aside from COVID, in the traditional market history, which was the dot-com bubble and also the global financial crisis. They said that the global financial crisis was, in part caused, or at least exacerbated, or at least we only bottomed out when rates bottomed, but rates decreasing certainly did not help it. And the same thing can be said about the global financial crisis. And so they're looking at the idea that interest rates can be dropping soon, and hence the S&P 500 will drop with them. Now, that's their claim. And then they are also claiming, right, because you might be thinking, well, how does this affect Bitcoin? They're claiming that Bitcoin and the S&P 500 and traditional markets in general are correlated. This chart here shows you in orange Bitcoin and then in blue S&P 500. You can see there is a vague correlation here, especially in more recent years. And so they're claiming that when the S&P 500 or traditional markets drop, Bitcoin's going to do the same. And hence, their overall claim is that a recession that is coming soon will drag down Bitcoin with traditional markets. Now, I have multiple problems with the claim that traditional markets will drag down Bitcoin, and I also have problems with the claim alone that traditional markets will drop. I actually don't think it's likely at all, really, that traditional markets will go down to new lows over the next couple of years, right? And you might be thinking, well, I think people have mixed opinions on this, because I think if you asked them a year ago or 2 years ago, they'd say, I'm completely wrong, of course, there's going to be a recession. Now people, I think, are maturing a little bit on the issue. But the idea of the traditional markets dropping now is relying on interest rates decreasing, leading to the drop. But previously, you will remember that the idea in 2021, in 2022, and in 2023, by the way, for the last 3 years, basically, people have been claiming this same thing. Probably 2.5 years. The same narrative. Recession's coming, Bitcoin's going down. That's been the same narrative for years now. It's been actual years. I don't think people necessarily understand. Perhaps they're not perceiving time correctly. These claims have literally been repeating for years and nothing has happened. In fact, not only has nothing happened, gold is at all-time highs. S&P is at all-time highs. NASDAQ, all-time highs. Dow Jones, all-time highs. Not only have they been wrong, they've been the complete opposite of correct, right? Which is like worse than wrong. They've been so wrong that they've actually missed the new all-time high and they're still spouting the same narrative. So that's not necessarily a reason not to believe it's going to happen in the future, but it's certainly a reason to believe that these people are not particularly reliable. The claim is not reliable. They were basing it in the past on interest rates. Interest rates rising was going to lead to a recession. And of course, that was true for a certain period of time, but now interest rates have been dropping massively. And, inflation, I'm talking about inflation rising will lead to a recession. That was true for a certain amount of time. But when inflation topped, what you'll notice is that when inflation topped, we saw the bottom. We saw the bottom around the time inflation topped. Inflation's been decreasing since then, okay? And now, unless we're going to have another spout of inflation, which is possible, the market probably won't drop again. And the thing about inflation is inflation's misleading, right? Because when you see inflation rising doesn't necessarily drop the market. In fact, it does the opposite, right? Because when the government's printing, when the Federal Reserve, is printing a ton of cash, all of that cash is flowing through directly into stock market, Bitcoin, S&P, real estate. It's flowing into all asset, right? So when what causes inflation? Well, realistically, one of the biggest causes of inflation is money printing, right? Increasing of the money supply. And if we enter another cycle of quantitative easing and inflation does end up going up, what will happen before that occurs, before that has any effect on the market, is a huge, gigantic pump, just like 2020. So if you're talking about inflation, which was the main thing people were talking about, which was going to lead to a drop, realistically, inflation is short-term, not directly inflation, but short-term. When you see inflation and you look a year before that occurred, it's generally mega bullish in financial markets. So the whole idea of a recession was based on inflation initially, and now they've shifted it to interest rates. But the problem with their shift to interest rates is that we've only seen that on 2 occasions, and 2 occasions is not a trend at all. It's actually not a trend. So you need 3 data points to make a trend, and in prior history, there's no real evidence of that whatsoever. In fact, it's quite the opposite. So the claims they're making are just not really grounded in data. They're saying it is because it's happened for the last 20 years, but you have to remember that recessions are very rare. And just because something has happened correctly for the last 20 years, that doesn't mean it's happened correctly for multiple data points. It's only been 2 data points. Not many at all, guys. Really not many at all. And look, I think the whole claim is faulty, mainly for that reason, but also as well, if we're going to dive into it a little bit deeper, it's also faulty for the fundamental reason that the markets predict the future. Okay, markets move in how they think the future will be, right? People don't buy. So for example, if Toyota is going to release a new car in 2025, people aren't going to buy when the new car is released. They're going to buy in 2024 when the new car's coming out, right? That's a very weird example, but or when the new car's rumored to come out, or when it's been announced, that's when they'll buy. The actual reality of what's going on is not what the markets are interested in. The markets are interested in the future. People buy thinking of the future. They don't buy thinking of the present, right? If today it's World War III, but everyone knows that by next week, World War III is going to be over and the market's going to boom again. They're buying today, even though it's World War III today. Okay, that's the reality. So the fact that the markets have skyrocketed to new all-time highs while people are still saying this whole bear thing is going to occur, this whole recession is going to occur, is kind of, in a way, a counter-argument to the idea that the recession will occur. Now, I'm not saying there won't be a recession. I'm just saying that there's no real data to believe there will be, because all the trends are not really trends. They're just kind of things you're pointing to that aren't really mathematically based at all. And going further in that same kind of segment is, there's another element to this. Yeah, cool, it's all well and good predicting traditional market's going to go down. I don't know how you necessarily do that, because I think all the ways they've used to do it in the last 3 years of false predictions have been wrong, evidently, because they've been wrong for 3 years. But another thing is the Bitcoin correlation, right? It's not just, if we're talking about S&P 500 stock market dragging down Bitcoin, we need to look into the actual correlation that exists between Bitcoin and the S&P 500 and traditional markets. We know for a fact that there was no correlation at all, zero, nilch, between Bitcoin and traditional markets up until basically 2017, right? But even then, there was no strong correlation, right? We had a period of time in 2017 where Bitcoin went downwards from their all-time high, right, or 20K all-time high in 2017 bull market. It dropped all the way downwards, right? All the way downwards to basically 3K, or 6K, sorry. So it dropped downwards, 75%, 70%. And in that period of time, the S&P 500 reached new all-time highs, right? Yeah, we had, it looks similar when you're looking at the chart like this in a blanket way. But if you're actually looking at the data and inspecting it closer, it's not actually as similar as you think it is. We've only really seen proper correlation between Bitcoin and traditional markets since COVID. And that's pretty obvious, pretty self-explanatory, right? The reason why we've seen that is because that's when they started printing huge swaths of money. And when you print huge swaths of money, everything goes up. So of course you're going to see assets be correlated. Everything will be correlated to each other when massive amounts of money come into the economy because everyone's buying everything. That doesn't mean that the assets are intrinsically correlated, right? And then you see when quantitative tightening starts, the correlations start to taper off again. These charts look similar when you layer them on top of each other like this, but they're not as similar as you think they are. That's the issue. A lot of people look at this and they think, oh yeah, Bitcoin and the S&P are clearly correlated. But if you actually inspect the data closer, you can see there's no correlation over here. In here, there's very rough correlation. In here, that's quite good correlation. But even in the last year or so, we've seen months on end where Bitcoin does a different thing to the S&P and traditional markets. So my point is not that they're not correlated, they are, but the correlation is nowhere near as intense as people are expecting them to be or think they are, right? We saw periods of time where the S&P was crashing and Bitcoin was pumping. We saw periods of time where Bitcoin was pumping, the S&P was crashing. We've seen this throughout history. It's only in the last 3 years that we've seen an actual correlation, measurable correlation between Bitcoin and the S&P. And in that period of time, we've seen months of faulty data. We had recently, in August, in 2023, in August, we had recently a full 6-month period where there was no measurable correlation between Bitcoin and traditional markets. Okay, so not only is the idea that a recession's coming, it's coming, trust me, it's coming, not only is that a faulty idea, because they've been saying it for 3 years on end and it's never been correct. Eventually, see, the thing with these kind of people, right? If you say the same thing long enough, you're eventually going to be correct. There will be a recession eventually. Okay, 18.6 year real estate and economic cycle predicts that recession will start in 2025, 2026. 4-year cycle essentially permits the same thing. These people are going to be right eventually. The problem is, what have they missed when they are not correct? For 3 years they've been saying this, and for 3 years they've been wrong. They've missed 216% gains on Bitcoin. They've missed the NASDAQ going upwards from 10,000, nearly 2x to 18,000, right? They've missed basically everything. So eventually they're going to be correct. The problem is, there's no way to predict exactly when this will occur. That's the issue. So we can't take it too seriously until we see actual data of it occurring. Right now, we're at all-time highs. It's very important. I actually replied to a comment that I wanted to show you yesterday. This guy said, you'll be singing a different tune when the Fed drops rates, okay? Insinuating that I won't be macro bullish when that occurs because the markets will start to drop. And I replied like this. This is the perfect way to end the video, I think. There's no evidence of anything. Will they drop rates? Will the rates drop the stock market? Will the stock market drop cause Bitcoin to drop? How long will it last? Will it break cyclical trends? There's so many questions with no objective answers. The best idea is to wait, see, and react when we have actual proof and actual data. There is absolutely nothing wrong with adapting to new data. There is something wrong with blindly guessing. And that's exactly what these people, these macro bears, are doing. They're blindly guessing. They have been for 3 years and they've been wrong for 3 years. So until we see actual data, the S&P 500 actually going down, NASDAQ actually going down. Right now, they're breaking all-time highs. But until we see the actual data of them going down and something starting to occur, we cannot predict that this massive collapse is going to happen and that everyone's wrong except me. We can't say things like that. What we can do is we can trust the data that's presently here. The data that's presently here that we should be trusting, because it's the only data we have, is that we have a 4-year cycle theory, which is very, very strong. We have a presidential cycle theory, which is very, very strong. We have an 18.6-year economic theory, which is interesting to say the least, if not strong. All of these things predict a regular cycle in 2024 and 2025, a bull cycle. From there, we don't know. But what we do know is this. If we start to see the S&P collapsing, we can just adapt our data and react to it. That's the simple reality. There's no benefit in being correct in predictions. Predictions don't make you money. What makes you money is adapting to data, right? And reacting to the situation. Right now, the data is much in support of a macro bull case. It's not in support of a macro bear case at all. But if that changes, we can just change our minds and adapt. There's no benefit you get financially from being contrarian and being wrong for 3 years, like all these people have been screaming for recession for 3 years straight. I've always stood against it. I stood against it in 2021. I stood against it in 2022. I stood against it in 2023. I've been correct all those 3 years. And in 2024, I will continue to stand against it. I will continue to trust the actual data, the actual trends. Ladies and gentlemen, thank you for watching the video. I hope you enjoyed. So guys, go ahead and check out the Crypto Academy's Become a Trader 10-unit course. If you're interested in learning how to trade, learning how to do analysis on financial markets, whether it be Bitcoin, stocks, whatever, anything off a chart, you can do it by doing this course. This course teaches you 85%, probably 90% of everything I use on a daily basis, and doing this course will give you the knowledge to become a proficient trader in a financial market. Not only does it go into TA, it also goes into FA. How to manage your emotions, how to find trades, what is a financial market, what is Bitcoin, how does it work, why is it better than gold? All these questions are answered in the course. Check it out. The website is below.